I went through 660 trades, 5 years of data on 2 pairs. I found something that genuinely changed the way that I run my strategy. There's one day where my win rate drops by almost 14 percentage points. One day where my expectancy, that's average return per trade, goes negative. And here's the kicker. When I simply stop trading on that day, my per trade expectancy jumps by almost 25%. And that day is Monday. Now, I know what you're thinking, oh, everyone says don't trade Monday. But the difference between me and everyone else is that I actually have the data to prove it. Not a hunch, not the market feels slow, but 660 trades across 5 years of data and 65 trades live. So in this video, I'm going to break down exactly what I found, chart by chart, and show you how one filter basically changed my whole strategy. So let me show you what we're actually working with so you know I'm not cherry picking nonsense. So this is the results of my strategy. I traded both on Euro USD and USD CAD, mainly during London session, but also New York session as well. Backtested across 2020 up till 2025. And I ended with 660 valid trades. Now, everything is measured in R multiples. All right, so bear that in mind. This normalizes everything, right? So we're just simply comparing apples to apples, regardless of position size or lot sizes or all that jargon. So out of those 660 trades, 119 of them landed on Monday. Now that's about 18% of the total. So Monday isn't being over or under sampled. This is actually a fair comparison and a fair sample size. Now, let's look at what happens when we break performance down by day. So here's the expectancy chart, which is average R earned per trade split by day of the week. Tuesday plus 0.47, Wednesday plus 0.43, Thursday plus 0.455, and Friday plus 0.65. And these are all healthy, positive numbers, all doing their job, right? And then there's Monday. Take a look at Monday. Negative 0.059. Basically break even, basically nothing gained, nothing really lost. But it's the only real negative day. And the gap between Monday and the next worst day, which is Wednesday, is around 0.49R. And that's not a small gap. That's a canyon. And now if we look at win rate, it basically tells the same story. So Tuesday through Friday all sit in between 41% and 47% roughly. And Monday, 26.9%. Again, that's a 14 percentage point drop to the next lowest day. And let me put that into perspective. On any other day, I'm winning roughly 4 out of 10 trades on average. On Monday, I'm winning closer to 1 in 4. And that win rate difference is the difference between making money and losing money. Now, here's where most people would stop, right? They'd say, cool, Monday's bad. Don't trade Mondays, right? But I want to go a little bit deeper than that because the obvious question is it both pairs or is it one pair dragging the other down? And this is what I wanted to find out because obviously I trade 2 pairs. So I need to pinpoint exactly where this drag is coming from. So when I break down the expectancy by day, split by pair, this is the kind of numbers that we come to, and the picture gets quite interesting. So USD CAD on Mondays is negative 0.15R across 70 trades. Again, that's properly negative. It's the clear culprit here. Whereas on Euro Dollar on Mondays, we're basically, around break even, but plus 0.07R. So technically positive, but barely. And when you compare that to Euro USD's performance on every other day, where it's averaging well above 0.4, Mondays is still massively underperforming even for Euro Dollar. And again, the win rate confirms this as well. USD CAD on Mondays has a win rate of about 24% and Euro Dollar has about 30% win rate. Both are the lowest win rates for the respective pairs. So it's not just one pair that has a Monday problem. Both independently show that Monday is the worst day. This matters because it's a cross pair pattern. It's not a quirk of one instrument, it's something structural about how these markets behave and how my strategy integrates into the markets at the start of the week. Okay, so the data looks bad for Mondays, but any decent analyst and any decent trader should be asking, is this real or is this just noise, right? Because it could just be noise. So The one thing that I did, and the one thing that most people should do when we're coming to conclusions that affect our trading, is to look at in-sample and out-of-sample data. So I split the backtest into two halves. 2020 to 2022 is my in-sample data, and from 2022 till 2024 is my out-of-sample. So the in-sample is where I first noticed the pattern. Again, completely separate data sets here for us to compare the impact of removing these Mondays. Now, the Monday expectancy in sample was negative 0.04R across 92 trades, and Monday expectancy out of sample was negative 0.09R across 29 trades. So negative in both halves. So again, the sign is still consistent here, and the gap between Monday and the rest of the week was 0.6R in sample and 0.51R out of sample. So that pattern does replicate. And that's the single most important test you can run. And Monday passes it, or rather it fails that test, which is exactly what we want to see. Okay, now here's another thing we need to check, and it's, are the confidence intervals actually separated? So this is the statistical heavy hitter here. So I calculated a 95% confidence interval for Monday versus the rest of the week. Now, Monday's mean expectancy is obviously minus 0.05R, but the confidence interval runs from minus 0.3R to plus 0.2R. So it crosses zero, which means you can't exactly say that Monday is significantly negative on its own. There's a chance it's break even and, we just got an unlucky sample. But if we look at the rest of the week, the mean is plus 0.53R. Confidence interval from 0.3R to 0.6R. Strongly positive, and it doesn't cross zero. And here's the critical finding here. The two intervals do not overlap. Monday's entire range sits below the rest of the week's entire range. And that means Monday is statistically different from Tuesday through Friday at 95% confidence. So the question isn't, is Monday bad? The question is Monday worse than other days? And the answer is yes. And we can say that with statistical confidence. And here's the two equity curves. The blue line is every trade, and the green line is the strategy with Monday trades removed. With the filter off, the strategy ends at plus 279R over 660 trades. With the filter on, it ends at 286R over only 541 trades. So you're making more R with fewer trades. Now, the headline number isn't the total R here. The headline number is what happens to per trade expectancy. Without the filter, we can see that it's plus 0.42R per trade. And with the filter, it's plus 0.53R per trade. And that's a 25% improvement in expectancy simply from removing one day of the week. You're doing less work, and each trade you take becomes more valuable. The win rate also lifts from 40% to around 43%, a 3 percentage points difference. And that one matters more psychologically because time spent in drawdown then drops from 72% to around 67%. That's nearly 5 percentage points less time underwater. And if you've ever traded a lower win rate system, you know how much that matters for your psychology. And finally, the Monte Carlo stress test. So I bootstrapped 10,000 simulations from each version, all trades versus no Monday, to see the full distribution of possible outcomes. The entire distribution shifts right when you remove Monday. The median goes from 279 to 286R, but more importantly, if you look at the left tail here, the 5th percentile outcome, meaning the worst case scenario, improves by 13R. So essentially your floor gets higher. Your worst reality improves. We can look at the 90% range from 208 to 350 to 221 to 352. It's a better bottom, right? Roughly the same top, but you're bringing your floor up, like I said before. And that's the definition of a free upgrade. You're not sacrificing upside. I'm not sacrificing upside potential profit. I'm just simply cutting downside. So what's the actual takeaway here? It's not just don't trade Mondays like everyone says. That's the surface level takeaway. And it's specific to my strategy and my pairs. The real lesson is this: most traders spend all their time optimizing how they enter trades. Better entries, better indicators, better confluence, but almost nobody optimizes when not to trade. And I just showed you that removing 18% of my trades on Mondays improved my expectancy by 25%. I didn't change a single thing about my entry model, my stop loss, or my take profit. I just stopped showing up one day a week. And here's the process I'd encourage you to follow if you want to find out similar things about your strategy and your approach. First and foremost is to log your data, and not just whether it's a win or a loss, but what day of the week it was, what session it was, what time of day it was, all these nuances that you should be tracking. Log all that data, because if you don't have the data, you don't know where the problem lies. You don't know what's dragging your performance down. And don't just eyeball the charts. Don't just see, oh, this kind of looks good. Actually calculate the expectancy per group and understand that performance. And step 3 is to validate in sample and out of sample data, because we can all over optimize for a set period of data. But if you don't compare it with an out of sample data, how reliable really is that data for you? Because if the pattern only shows up in one half, it's probably just noise. And so I didn't find the Monday filter by guessing. I found it by building the infrastructure to ask the questions. And that's the edge most retail traders are missing. Not a better indicator, but a better process. If you found this useful, I'm going to be doing a lot more data-driven videos, breaking down every filter, every optimization backed by real statistical numbers around my strategy and my live data as well. Make sure to hit that subscribe button to see the next video. Give it a like, thumbs up, and I'll see you in the next one.